there is pain on the street, and therefore it's just the most opportune time to get in somebody who looks at India and the rest of the Asia-Pacific region from his perch. Herald Van Der Linde, Head of Equity Strategy Asia-Pacific at HSBC, joins us right now on the show. Herald, great having you, and it's just an opportune day to get you because we've wiped out nearly 4,000 points on the Nifty. Now, I remember you used to be constructive earlier, sometime around 2 or 3 months ago, if I'm not wrong. You turned a bit cautious on India as well. I would love to know, in the current Asia-Pacific thoughts that you have, post the corrective moves that we've seen in a clutch of Asia-Pacific markets, excluding China, what is the current hypothesis that you have?
Good. So you're right. We actually started to become a little bit more worried about India in August last year, but we didn't anticipate the sort of slowdown that we've seen in India. So here we are, February. What do we do with this from here on? Because we've declined, some of the worries that we had in the past, such as valuations, there may be still a little bit there, but not as much anymore, because valuations have come back to some sort of, you could say maybe an historical average, although against China, that is, on an absolute basis, it's still a little bit expensive. Another worry we have is that the earnings are slowing, but that has materialized to a large extent as well. Is there further downgrade risk to earnings? I suspect there is to a certain extent, but maybe not as much anymore. I think the risk comes from 2 or 3 fronts. The first risk is simply that locals have continued to remain fairly resilient buyers. We've seen a lot of supply in the market as well. That probably is going to dry up automatically. But if local support would dwindle and people get nervous, and remember, a large part of the people that have invested in Indian equities have never seen a downturn. So that could be something that we need to keep a close eye on. A second thing that we need to keep a close eye on is simply what happens with earnings in India. The general consensus that there's a reset. We've had some really fantastic growth numbers in India for 25% or so over the last 3 years. The feeling is that there will be reset to maybe something close to 15, but what if it is much lower? And we can go deeper into this, but I think there's risk that maybe margins come under pressure. And the third risk is simply China, because China is doing well, it has rallied, but it's not overly expensive. People are still underinvested to a certain extent in China. Things are improving there, and that could, of course, suck more money into India. So yeah, the risks remain, but we have to also be realistic that a lot of the downside has probably paid out as well.
Herald, good morning. Tamanna here. In terms of the doubts playing out, in your view, what is the primary concern that we're seeing reflecting in the kind of foreign investor flows from the Indian perspective? It's been a one-way street, and all of it for the exit door. Do you see any factors changing that soon, since a lot of global liquidity is heading in the direction of the United States right now?
That is right. So money is moving in the direction of the United States, but that is changing as well. So if we see that money is moving out of the US and bond yields come off, then money would go back into emerging markets. That could be a first positive for markets such as India. I mean, it would be positive for other markets as well. If I talk to foreign investors, the key concerns that come up are twofold. One is, what if there's something really bad with Indian earnings? Maybe it's worse than we think it is. That is just normal that comes up. If earnings are being downgraded, people just don't know where the bottom is. But the comparison we, for example, make is with Indonesia. Indonesia invested a lot, like India has done over the last couple of years, infrastructure, roads and railroads and ports and these sort of things. And that has led to increased competition domestically and a decline in margin in certain sectors. So is that something that will play out in India as well? That's uncertain for now. But I think it's fair to say that most of the earnings downgrades we've seen. The other concern that foreign investors have is, what are the locals are doing? Because if they don't really want to buy this market anymore, there could be that there's further downside here. So the foreigners are looking at the locals are looking at the foreigners. We still are not clear where the earnings are ending up. As you say, rightly say, some money has flown back into the US over the last couple of months or so. But I think that might be changing, actually.
Let me just stick on to that, on why you think it might be changing. And a very interesting point you made about foreign investors looking at what Indian investors are doing. So if I look at DII flows and what is happening with our mutual fund industry, and that's really the big change over here in the last 4 or 5 years, that seems relatively rock steady, isn't it?
It seems rock steady, but these things can change, right? So let me answer the first question first that you had on the US. What we've seen in the US is that bond yields actually haven't moved anywhere. And bond yields are the indicator of flow, if money flows in or out. So despite the fact that initially there was a lot of optimism, we've seen now the US market has come off. Bond yields are starting to trend down. People are talking about maybe, hey, with all the uncertainty in the US, maybe rate cuts are starting to come through. So that's something just to keep in mind. So it might well be that we see money starting to flow out of the US. But for that, really, we need to see those bond yields come down. Now, to come back on your second issue, what are foreigners looking at with locals? We know, for example, that mutual funds in India now sitting on very high cash levels. So they are increasing their cash positions. And there's a couple of $1 billion coming from these systematic investment plans and these SIPs coming in every month. But in January, if I'm not mistaken, we saw for the first time a number of cancellations exceeding subscriptions to this particular program. So it might well be that domestic sentiment is shifting. And I think foreigners are keeping a very close eye onto this.
Herald, okay, one thing is that the domestic investors have been resilient. If they continue to be resilient, let's say hypothetically, right, because it's a difficult one to fathom, if they continue to be resilient, right, then does the return of the foreign investor depend on valuations going lower, which will be a factor of them continuing to selling Indian markets, or will it be Indian markets having reached the long-term averages? Let's go out and buy, because I remember note after note in 2024 spoke about how the long-term thesis remains intact. This is more a short-term blip which will get corrected.
That's right. So if people were eager to win in the market at, say, 21 times earnings, they would be eager to buy the market at 18 times earnings, right? So it's not the absolute level of valuations, but what we need to see is that the valuations have come down. That has happened. And then the other kind of ingredients for the Indian market need to also move in the right direction. So that is, for example, lower US bond yields. And maybe if, for example, the Chinese market loses a bit of steam, then suddenly it is, okay, the China rally is over. So, hey, India looks cheap again. Maybe we should rotate back into that again. And again, the earnings, the worries that people have on earnings that there would be further downgrades, that always happens when earnings are being downgraded. We just don't know where the bottom is. But if the long-term story remains intact, at some point in time, that will stop as well. So we got to look at these particular indicators, earnings downgrades, China, US bond yields, and if they move in the right directions, and the valuations are a little bit lower than they were at the peak, which of course they will be, then I think those flows can come back. And if it's 18 or 19 times earnings, people say, well, okay, I did buy it at 20 times, so I'm happy to buy it at those valuations as well.
Herald, I'm presuming right now, when you are advising your clients, you are saying that, okay, China is doing well right now, they have a revival, let's stick to China. India is maybe at good valuations, but something needs to give, either in terms of more correction or China giving way. I'm presuming that's the thesis right now.
That is indeed the thesis that we have in the moment.
Okay.
China is doing good, and there's things moving in the right direction in China.
Got it.
For a long time.
Got it. I have one more follow-up here. After let's say, in the last month and a half, Herald, we've seen the Indian regulators or the people in power, right? The finance minister, the central bank, all of them putting their weight behind trying to spur consumption, ease liquidity constraints that might be there. So the moves that have been taken have been pro. I'm not saying they've been done for the equity markets, but they are pro equities. Does that stand out for a global strategist like you as a key factor?
Yeah, I must say that is positive. I mean, yes, so they try to support consumption, although the problem with consumption in India is that urban consumption is weakening, and the rural consumption, it seems, takes time to really catch up. It might do so but that will take a little bit of time. So there remains a bit of uncertainty there. The central bank clearly has been talking about, okay, liquidity needs to be good into the system. So the noises that the policymakers are making are good. Also, I think the sort of fiscal discipline that India has put in place allows a central bank to cut interest rates. If there would be much more fiscal stimulus, then it would be more difficult for a central bank to do so in fear of overstimulating. So I think actually what the local policymakers are doing is probably okay. It's just that the equity market is not only driven by what they do, but also by global factors. And yeah, there's nothing India can do about that. You need to wait for those factors to move in the right direction as well. But domestically, yeah, they're trying to support some of that consumption. They're trying to put liquidity into the system. True. And I think it's possible.
Okay. Now, Herald, just one more slightly inward-looking question. I know you've established that a lot of factors go behind this. I'm saying let's assume China doesn't quite slow down for their markets. I wish them best. But Indian growth, which had suffered in Q2, and we have the GDP print today for Q3, let's assume that is slightly better. And towards the end of March, we hear some fairly positive commentary from corporates, etc., about Q4 growth. So my point is, if Indian growth revives meaningfully because of all the factors done and a natural cyclical upswing after the first couple of quarters which were weak, is that a sharp antidote, or is that not a sufficient condition for the markets to revive and we need global factors to change as well?
No, I'm a believer that China and India can move at the same time.
Okay.
Because the stories in these two places are quite different. So if China continues to do well, and India does also well for all the reasons that you just mentioned, I think, one, we're going to see money rotating within the region. It probably is not very good news for Taiwan or Korea or something like that, because we can't assume that all these markets are doing fantastic, or ASEAN. And secondly, it will probably mean that people would want to move money into these markets from outside the region as well. So EM funds could come in, global funds could come in as well, as money is being reallocated. So I'm a believer that these two markets can move at the same time in the same direction, in a positive direction, I mean. So if these growth worries are going away and Indian growth looks okay again and the valuations look good, I wouldn't be surprised if people say, hey, there's something really interesting going on in India and the valuations look good. We need to be there while we don't want to sell China. So yeah, maybe we should reduce our exposure into Europe or the US or something like that.
Herald, you know, we've been talking so much about the atmospherics. I must come to you on this very interesting report from your end on top 5 picks in a slowdown from the Indian perspective. So let's come to some of those specifics and go through some of those names. Maruti, PB Fintech, Dixon, among those. Can you talk a little about why you have picked these particular companies in the context of the fears of a slowdown?
Yeah, typically, I think if you are in a sort of downturn in a market, you want to be in companies that have particular sort of dynamics going for them. Either they're gaining market share, or they're in a segment in the economy that continues to grow. I mean, if the economy slows, it's not that the whole economy slows, there's always a pocket that does well. But most importantly, you're looking at companies that have a brand or something like that. Because if you've got a strong brand, even though demand is slowing, probably you're not going to slow as much. And of course, you're looking at stuff like valuations and these sort of things. But it's branding, it's resilience of the business that you're really looking at. And you match that with the valuation in the markets to come to key ideas in a downturn. And that's exactly what we've done in this particular report.
Well noted. Herald, thank you so much. This was so informative in more ways than one. Much appreciate you taking the time out and speaking to us today.
Thanks for having me on.
That's Herald Van Der Linde. And for all of you who maybe missed some part of the conversation, he's saying that something needs to give. Maybe a China underperformance, but to a question of if Indian growth were to come back, even if China were to do well, would money return? To which his answer was yes. But it's not just growth which will determine it.
So my big takeaway, though he didn't say it in as many words, was in the context of all money moving towards America right now, and that could be changing. So once you know, bond yields come off, don't look as attractive, maybe this thought that America is going to boom under the current policies. If that fades, then emerging markets come back on pace, is at least what I thought was interesting. And of course, they're top 5 in the India story.